This morning, you deposited $1,000 without talking to a single human being. You pointed your phone at a piece of paper. It buzzed. A number went up. And somewhere downtown, behind marble columns and a steel door thicker than your arm, you can picture exactly what happened next. Your $1,000, in a neat stack with your name on it, settling into the dark. Everyone has that picture. You've been carrying it since you were 6. And here's the strange part. Money got so easy, so instant, so invisible, that you've never once asked the question this video is about. What happens to that stack on the day the bank dies? Because banks die. Quietly. On schedule. Usually on a Friday. In the 5 years after 2008, 489 American banks failed. You probably can't name 3 of them. By the end of this video, you'll know the strangest fact in modern money. Your bank can already be dead, sold, and buried before anyone tells you a thing. And you'll know why that is the best designed machine you've never seen. It starts where your picture starts. The vault. And the vault picture is a good one. Piggy banks taught it to you. Heist movies taught it to you. Every cartoon where a billionaire dives into a pool of gold coins taught it to you. Money is a thing, and the thing lives in a room. So when your deposit clears, your brain files it under that picture. The teller takes your stack. The stack rides a little cart down a hallway. The big door swings open, it weighs more than your car, and your bills settle in next to everyone else's, like coats in a cloakroom. Still yours, just visiting. And if you ever walked in and asked, someone would go to the back and fetch your exact bills off your exact shelf. Banks have spent 200 years polishing that feeling. The marble, the hush, the heavy door. A bank's whole business runs on how calm you are. So let's do something banks would rather you didn't. Let's follow the actual bills. The teller's drawer keeps a small float, enough for a normal day and nothing more. The rest goes to a counting room in the back, and by mid-morning, your specific bills are in an armored van, headed to whatever corner of the city is running low on cash. So your $1,000, the stack, the name tag, the shelf, it's not in the vault. It's not even in the van. It was gone by lunch. And it gets stranger. Ask how much of everyone's money a bank is legally required to keep on hand, ready to pay out. Surely 10%, right? You learned that one in school. In the United States, since March of 2020, the answer is 0. 0%. The Federal Reserve set the reserve requirement to nothing, and it has never been turned back on. What the bank actually holds is a row in a ledger, a promise with your name on it. The vault, the marble, the giant steel door, set dressing. Every marble column exists to keep a promise from feeling like a promise. Which makes the question from the beginning genuinely scary. If your money is just a promise from a company, what happens to the promise on the day the company dies? You know what it used to mean. Between 1930 and 1933, about 9,000 American banks failed, 4,000 in 1933 alone. And when a bank died back then, there was no playbook. There was no insurance, no net, no number to call. The doors just locked. If you were early, you got your cash. If you were late, your savings didn't move somewhere else. They stopped existing. Families lost everything to a padlock and a handwritten sign. It got so bad that in March of 1933, the president shut every bank in America, all of them, for a week, just to stop the bleeding. That disaster is still written into your instincts. It's why some part of you would still sprint to the ATM in your pajamas at the first bad headline. So here's the wall. A bank death should be an extinction event for your savings. It isn't, because somebody built a machine for exactly this moment, and the machine does something almost insane. It starts working before the bank is even dead. Your bank doesn't die suddenly. Regulators track every bank's vitals, and they see the end coming. And when a bank is terminal, the strangest auction in finance begins. The FDIC quietly puts the dying bank up for sale while it's still alive. Other banks are invited under strict secrecy to study it and bid. The customers don't know. The tellers don't know. Most of the bank's own staff don't know. By the time you hear the first rumor, the winner may already be chosen. Then comes Friday. Banks die on Friday evenings, by design, because Friday hands the machine a gift, 2 full days when the doors would be shut anyway. In January 2009, when the Bank of Clark County failed in Washington state, roughly 80 FDIC agents slipped into town ahead of the announcement. Plane rental cars, staggered arrivals, Hotel rooms booked under fake names, so nobody in town would count the strangers and start a run. At exactly 5:01 in the evening, 1 minute after closing time, a small team walked into the CEO's office and told him that the bank he was standing in no longer existed. And then comes the part nobody ever sees. All weekend, through the night, agents and the winning bank's people sit inside the dead building, matching every account, every loan, every safe deposit box, moving your row from one ledger to another. No money moves anywhere. Only the promises change hands. Monday morning, the doors open on time. Same tellers, same pens on chains, new name on the wall. Your card worked the entire weekend, and for most customers, that sign is the only thing that ever changes. You think that can't possibly scale. September 25th, 2008. Washington Mutual. $307 billion in assets. $188 billion in deposits. More than 2,300 branches across 15 states. The largest bank failure in American history, then and now. And the run on it was so heavy that the FDIC didn't even wait for Friday. They took it on a Thursday. That same night, while the country slept, the entire bank was sold to JP Morgan Chase for $1.9 billion. Every branch opened the next morning. Every depositor, including everyone sitting far above the insurance limit, kept every cent. The collapse of a $300 billion bank cost its customers exactly nothing. It didn't even cost the insurance fund a cent. Think about that for a second. The biggest bank death in history was handled overnight. Okay, but the overnight trick needs a buyer, and once in a while, nobody bids. That happened too. IndyMac, July 2008, $32 billion and no buyer in the room. So the FDIC took the bank and simply ran it itself. Insured customers had their money by the next business day. That's not marketing. It's the FDIC's own printed standard, usually the next business day. About 10,000 people were over the insurance limit, and even they were immediately handed 50 cents on every uninsured dollar, with more arriving as the bank's assets sold off. Slower, bruised, but waiting, not ruined. And the shield itself? $250,000 per depositor, per bank, backed by the United States government. It was born in 1934, out of the exact apocalypse you watched a minute ago, and more than 12,000 banks signed up on day one. The first person it ever saved was a woman named Lydia Lobsiger in East Peoria, Illinois. July 5, 1934. Her bank was dead. Her $1,250 of life savings came back in full. She was the first. Here is the streak since no depositor has lost a penny of FDIC-insured money since 1933. Not in 2008. Not once. 92 years and counting. One more thing, because you're probably assuming your taxes pay for all of this. They don't. Congress doesn't fund the FDIC. The banks do. Every insured bank pays premiums into the fund, year after year, like any customer buying insurance. Read that again. American banks prepay for their own funerals. So, tomorrow morning, somebody, somewhere will point a phone at a piece of paper and a number will go up, and they'll picture a neat little stack settling into a vault where nothing has really lived since 1934. Not you. You know the stack left by lunch. You know the vault is theater. And you know that underneath it all hums a machine that can bury a $300 billion bank on a Thursday night and have the doors open by Friday morning. A machine built so well you never had to learn it exists. Banks still die, your money doesn't, and now you know exactly why.